Here we are, sort of back to a full week, not quite a full week, but we're back to plenty of action in the markets this morning. We had quite a few little breakfast trades triggering off, but that's not going to be the subject of today, although we will just take a glance at those. The subject today is to look at harmonics and Fibonacci and waves and the little connection between them all, but we're going to do it in relation to what is actually going on in the market right now. Now, let's just take a little glance at, let's just bring this across, bring it up. Now, a good many people consider things such as Elliot Waves, Harmonics and Fibonacci as being something of a black art, where people will sort of dance around a campfire, chanting and coming up with all sorts of crazy ideas. It's almost a religion to some people, or indeed that's maybe how some people look on it. But of course, it's nothing of the sort. Those three features, starting off with Elliot Waves. Elliot Waves, well, you know, they can be very, very complex. But if they are complex, the most important thing is just to ignore them completely. If you do a little bit of study on Elliot Waves, you start to realize that there is actually a very, very simple way of looking at Elliot Waves. And when you see them, you trade them. When you don't, you do not look for them. They've got to jump off the page at you. They've got to jump off the screen. And once you've got to that state, then you can make full use of them. In terms of Fibonacci, now that's also considered to be something all a little bit too complicated and rather strange. But quite simply, Fibonacci is something that the market tends to take on board, and it tends to use it in some markets. And in Forex, it is used very, very widely by a tremendous number of participants. And we'll be able to see the evidence of that in just a moment. So quite simply, it would be wise that we as traders have got an awareness of Fibonacci, because the majority of other traders use it. And as we know, markets are driven by herd mentality, and that herd mentality means that sometimes it will change direction. The herd will sort of gallop in one direction. For some reason, it'll turn around and go in exactly the opposite direction, turn around. And what is the reason for that quite often? Well, some of those in the stampede have seen a Fibonacci level, and then others catch on to it, and they all turn around. Why is that? Is it because of some mystical influence from the heavens above? I don't think so at all. It's just purely the herd turning at a point, and if we can be aware of where that point is, we can actually follow the herd, or at least we can get ourselves in front of the herd to turn, and we can front run the herd. And then what about harmonics? Well, harmonic patterns, we've got a few in front of us here, a whole series of them. We've got things like crabs and butterflies and garters, etc. A bat pattern. Well, you know, all these strange names are really immaterial, but we're going to look at these in practice in just a second and see sort of the reasons why they can be really quite effective. So let's just go straight then to the markets, and let's see if we can sort of find one or two of these which just might start to tell us something. Got any questions along the way? Don't hesitate. Anything that you want to sort of pick up or challenge, that's absolutely fine. You know, just do mention these things. Now, got in front of us a series of charts. This is MT4, and we're just going to take. Well, in fact, I think what we'll start off with, we'll just look at this chart. This happens to be a 30-minute chart of the Australian dollar, AUD/USD. Now, we've had quite an interesting morning on the Australian. simply because at 5:30 UK time, there was an announcement that came out of the Reserve Bank of Australia to say that they were keeping interest rates on hold. Now, the market had assumed that the Reserve Bank would actually reduce interest rates, and consequently, over the last, well, let's just look at it on a daily chart, there has been this general sell-off, and of course, most recently, just over the last 10 days or so, we had this major sell-off, went to a new low on anticipation of that news. Well, that news didn't actually follow through in the way that the market expected, and consequently, we get something of a bounce back. And that's exactly what we've got this morning. So coming back to this 30-minute chart, what we can see is that I've got a number of lines on here, and the most prominent of these little markers, as you can see, we've got a 50%, we've got a 61.8, and various others. We've got a 127% butterfly level. Now, purists within harmonics will say, it's got to be the pattern. It's got to be the pattern. And they will only trade harmonics when the pattern is perfect. Now, I'm not going to go into a tremendous amount of detail on what is and what isn't a perfect pattern. But for me, the most important thing is the level. And we very often will find reversals at important levels. If we take this one, more or less in the middle of the screen, where we've got two little yellow markers, we've got a 50%. So that's a 50% retracement to a previous level. And we've got an extension, which is a butterfly level extension, 127% from a previous high. Where they both come together, lo and behold, we find that that has been a reversal. Please do, Chris. Then there must be something in this if we find that we've got two little lines meeting at a point where price actually reverses. Yeah, moving averages. Yeah, I have got on here, let me explain all of this. We've got various moving averages, and what I guess is that we're not sort of overly interested in them. This longer term one is a 34 period color change trend. And quite simply, when it's moving down, it's one color moving. When it moves up, it's another color. We can actually just change this if we want to. The shift. Sorry, Chris, you'll have to further explain quite what you mean by the shift. So we've also got then another line here, and this line moving on up, it's a 13 period. It's a Fibonacci number, not that that's necessarily significant, but we could quite happily just take these off and just look plainly at price action. So they give a broad definition of trend. Now there is another line on here, and you'll notice that this line alternates between red and green. Now this line is my trade management line. Okay, it's a trade management line. And quite simply, when it changes color, it's telling me that we've got a potential change in trend, and I will follow it on up then, assuming that one were to take the trade. I follow up then a stop behind this line. Okay. Then at some point, it'll change to red. And as you can see, it pops straight up. And I've now got, assuming that one were to go short at this point, I've now got a place to put a stop. So that's what that line is about, and it comes into its own, particularly when longer term swing trading. So coming back to Fibonacci and harmonics, we had this little run up to this butterfly level and the 50% retracement. Price then actually came back, and it came back very, very neatly to an area where price bounced up from before. We could almost look on this whole pattern as something of a reverse head and shoulders. And we can look on this as being a left shoulder, a head, and then over here we've got a right shoulder, and then price just absolutely takes off, having popped down to the all-important 61.8% level. With about a nice little zigzag zig movement that brings price then just on back down to a 50%. And that brings me to one of the most important aspects which links in waves, Elliot waves, it links in harmonics, and it links in Fibonacci. If I take a line from this high and take it to this low, I'll put in another one just up to that level, and then a further line running on down. So I've got three lines. Now, this may well be something that you use, and if you do use it, I absolutely commend it to you. Do keep using it. So just by drawing three simple lines, we've got what is effectively a move down, a little rally, and then a move down again. Within the use of Elliot Waves, this is what they would call an ABC correction. And ABC corrections are incredibly useful because where you've got an established trend, inevitably there is going to be some form of correction, some form of pullback. And this pullback will very, very often make this formation. So it'll make this pattern. Now, it's quite often called a measured move, and a measured move is when these are quite symmetrical. So the first move down would then be exactly the same length as the next move down. Hence the measured move. One can be measured against another. And this will give us, at the end of this measured move, it will actually give us an entry point. It'll give an entry point. Now, some people are going to be really quite concerned to just sort of measure the distance and decide that they're going to want to enter at that point. And the question then arises, well, do we use 100% or do we use something else? And it's a feature of these measured moves that sometimes this leg of the move is going to be a little bit shorter or a little bit longer than the first leg. And it'll quite often come down to a Fibonacci level. Now, we found that this has come down to a 50% level. And there's a very, very simple way of, once you've observed this, of then getting in at a reasonable place. And the way to do that is with a simple line. You just draw a line from the top, pick up the point at which it rallied, and then extend the line on down. Lo and behold, when price breaks that line, we've actually got an entry point. So the entry point then can be based on a break of that line. So there's nothing too fancy, there's nothing overly complicated about any of that, and we can use this almost as a trading system in itself and just use it time and time again. Right, let's go and look at another example. All right, Chris. Sorry, I wasn't entirely clear on what you meant with the shift. Shift next to period. Do you mean the different numbers that we're actually using on the moving averages? Right, we're going to move over now to a daily chart of gold. Now, the daily chart of gold is getting really quite interesting now, because what we've seen is that there has been quite a major move on down. And we can just about pick up, the software has actually picked up a nice little zig-zag zig, or one of these A, B, C moves, or a measured move. And what you can see quite clearly is that the move on down, this move, the C part of the move, is considerably less in distance than the A part of the move. So price then decided that it was going to perk up from here. And as you can see, the red line where the stop would be placed, assuming that one was short, eventually turned to a green line. We've had price pop up. Now, so far, we've had a potential A move and a B move. And what we've not yet had is a very, very clear C move taking off. So what could be about to happen is that, having seen that move up there, followed by this correction, question is this going to carry all the way on up to maybe that 1250, 1260 level? Or indeed, is it going to actually turn around and come back down at this point? We've seen that it's popped up to a 50% level. And if we take this high to this high, it's actually popped up to what is the FB reversal level. Now, let me explain what the FB reversal level is. The FB reversal level then is a false break reversal level. And what will very, very often happen in markets in general, particularly in currency markets, is that price will pop up to a previous level and it will put in a reversal. But so often, the market makers, or whoever is the dominant player in the market, will want to run the stops. And so they run it just above a previous level or below. And lo and behold, we so often find that it is 112.8% that they run it to. Well, they've run it just enough to catch people's stops, and then lo and behold, what happens? It then pops down again. And it's entirely possible that what you're saying there, Chris, is absolutely right. Notice also that this level is at a previous level. Just looking at this particular formation and where price is right now, we got a question. And the question is this now going to follow through onto one of these measured moves? Or indeed, is it going to do, as Chris suggests, that it's going to meander on back down to 1170? Right, well, the odds now, right now, because of price action retreating from this false break reversal level, from a previous high, from a 50% level, suggests that that just might possibly be the case. And so, if we were previously long on this, we would then have to make sure that our money management is going to cope with that, and that if we're running our stop up behind this little green line, we've got to make sure that we follow firmly the rules, which would be that we would need to close the position if price, the long position that is, if price actually came back and put in a close just below that green line. Right, let's go and look at gold somewhat longer term for a moment. Now, if we take a little glance at the longer term monthly chart, as you can see, it's running right the way back to 2009, and it's catching the major move that just seemed to want to run up forevermore. And what we've seen then is that price got to a point where it just couldn't sustain itself any longer, and it put in one of these classic key reversal candles. Now, you can see that the high candle, the high month, went higher than the previous month, and then it crashed right the way on down and it went lower. That is a classic key reversal. And if there's one candle that needs to be respected, it's one of those. Now, price did actually make a little bit of a rally on up after it attempted to break on down. And lo and behold, it came up to one of the other quite important harmonic numbers of 70.7, whereupon it just decided to move on down again. And what we can do is to base where we're going to go short on this on several things. We've got a 70.7 harmonic level. We've got price now rallying up to this red stop line. Didn't go through it, didn't close above it. Had it done so, this would have changed color yet again to green. And the other thing that we could do is to use one of those simple lines again. We could just pick up a series of lows, and as price breaks on down, we could actually just join the short. Where do we take it to? Well, as we can see, harmonics come to the fore again, picking up a 61.8% line, and that's where price decided that it was then going to move sideways, and as we can see, it's been moving sideways now for the best part of 2 years. Now, it's entirely possible that this low that moved on a little lower down has picked up butterfly level. But again, I'm not interested in the pattern, but I'm interested in the level. And, these butterfly levels very often will lead to a reversal, and we've had something of a reversal going on here. And it's only when this red line turns green that I will be starting to think that just maybe we are ready for something of a major reversal there. Now, let's just look at the dollar index, because the dollar index has been driving most of the action over the last 3-4 months or so in the foreign exchange market. It's all about the dollar. It's all about the dollar right now. And the dollar has been rallying. We are told on the assumption that US interest rates are going to be increasing. Now, that assumption has started to wither away somewhat with recent comments coming out of the Fed, and particularly with the non-farm payrolls that we saw coming through on Friday, which suggested that just maybe the US economy is not as strong as many had thought, and consequently the prospect of needing to increase rates has started to dissipate. So here we are, we've got the dollar index, it's run up to 100, it's then decided to come off, and it came off very, very heavily, as we can see on that day, where price just sliced through most of this rally. And where did it come down to? And this is the all-important thing to look at. It came down to one of these BAT levels. Now, a BAT level is a very deep retracement. It's an 88.6% retracement. This is not a BAT pattern because it hasn't got one of the all-important little correction points which purists will measure. Not interested in that. All I'm interested in is the level, and the fact that it came right the way down to this level. Just look at how that one bounced on back up. So anyone who was trading on that particular day would be able to look at that and would have got themselves an absolutely excellent entry. Now, there are one or two others. You'll notice that there are some Gartley levels. So the bat level is the deepest retracement that there is before it were to drop down to a previous level, which would make it a double bottom, or a little bit further, where it would become a full spike reversal level at 112.8%, or indeed going a little bit further still to the butterfly level that we just looked at. But the next one, and probably the most common harmonic level, is the Gartley level at a 78.6% retracement. Now, again, I'm not bothered about the pattern. I don't really mind what it looks like, as long as price is coming to that level, and it then gives some evidence that it'll bounce. And what we so often find is exactly this, where price ran up to a Gartley level, it then pushed its way back down again, lo and behold, to another Gartley level. And then we had a breakout move on the upside, that came down to a bat level before giving us price action, a very clear price action day, when the dollar index just shot higher. Red line turns to green, away we go, follow it up with a stop behind, and there's not a great deal to do. We just wait and just keep monitoring it until such time as price then decides to break down below it. So which way now for the dollar index? Are we going to see the dollar really chasing ahead, as clearly it has done? Are we going to see it going shooting above that 100 level, or indeed is the tide about to turn? And this brings me to another level which is very, very important. It's called a crab level. That's not important, but what is important is the measure, 161.8%. Now, 161.8% is one of the harmonic levels, but it is also a prediction level. It's a prediction level which is very much based on Elliot Waves moving out of a Gartley and also a bat level. So it's a pretty important predictive level. And indeed, if you were to look at some of the material from, there's a guy called Tom DeMark, and there are sort of one or two hedge funds, major hedge funds that he's advised, and they used the crab level, or the 161.8 extension level, as their predicted levels for when a move is probably going to reverse. And lo and behold, that's where the DXY is right at the moment. And Chris, yeah, we've just got to wait and see. It may or may not come through. We've got to wait and see, what the FOMC minutes are going to sort of tell us about all of this. But it's all in price action. It's all in the price action. So we're at a critical level right now. If we put a little bit more data on screen, we can actually see that the dollar index has been a lot higher than where it is right now. And despite the fact that we've got that crab level, what we haven't yet got is an important harmonic level picking up from that previous high. What you will notice is that we've got a bat level right the way on down here. And that's where this move started. And that then became the predicted level, where I'm absolutely certain that whoever Tom DeMark is advising right now have been selling. So if we consider then what is going on there with the dollar index, let's just whiz over to the other side of the coin there, which is the euro. And we've actually seen the euro now start to find an area where it wants to do some rallying. And it's been attempting to do just that. We can see that on this move on down, we've got the red line, which has turned to green as prices actually bounced up quite strongly. And it's put in one of these ABC moves on the way up to a 61.8. So what we can see is that we've got a move there. It then just bounced on back down and bounced up yet again. So where you've got a combination of things, a combination of what is this A, B, C move, this measured move, plus it comes up to an important harmonic level, then it starts to build up a picture that just maybe, it's ready to reverse. Add to that a third piece of very, very strong evidence, which is this bearish day, this bearish candle. Price went higher and then it went lower than not only the previous day, but also the day before that. What we've then got is a key reversal, suggesting that that was going to be a really, really important level above which price is going to find it a little bit difficult to move. And sure enough, what we found is that price that started to move on up to push higher here has shied away and it's now come back for some support. Now, that's not to say that we're going to get this crashing down, but for the moment, that has proved to be sufficient resistance to mean that the bulls just haven't got the power to push it. Now, it's worth just mentioning this other little indicator we've got, value finder. The value finder is very, very good at finding these extreme levels. So at an extreme high, and the value finder goes up to that extreme high again, we very often will use this to find the best shorting places when it goes high. And when it goes low and starts to diverge and move on up, then they're going to be the best buying places. And we also bring in a little volume calculation also. You'll notice that some of these candles are red, some of them are green, some of them are blue. Well, quite simply, red candles is where there is a tremendous amount of volume activity going on during the formation of that candle. And consequently, it means quite a bit more than when we've only got a very light blue, which means exactly the opposite. And that's limited activity going on, and consequently, there's not quite so much volume going through, and consequently, not quite so much volatility is going to sort of creep into the move on those particular candles. So there we are. That's the euro, which is now currently a little bit stuck in the middle. Can't quite decide whether it's going to go lower or indeed higher, but it's going to be largely based on a combination then of the fundamentals, which are clearly going to, which are still bubbling quite strongly in Europe, and of course that dollar index. Now, I want to just bring you right the way back to the short term, and let's see if we can just bring up this one. Hopefully you can now see a series of charts where we've got the euro, pound against dollar, and the Australian. Now, let's just stay with the euro for the moment. What we've been looking at is longer term charts. But if we come down to the shorter term, we can actually see that harmonics work just as well. So if you're a longer term swing trader, or indeed your short term intraday trader, then you can use this in exactly the same way. Now, you can argue that this is a bit of a mess of a chart because we've got far too many things on here at the moment. But what I want you to do, I want you just to focus on what have been some of the major turning points. And these major turning points are largely, nearly all of them, are being picked up by these key Fibonacci levels. If we look at the one at the top, at the very, very top, that came yesterday, or at least on Friday's trading, then we got a false break reversal level. Price just popped above the previous high, took out a whole load of stops that there would have been there, and then price promptly crashed. Doesn't that happen so often? And it crashed on down. First of all, it put in a little bounce at a Gartley level. Now, let me just say this, that where we've got an important level, where it would be highly likely that at the very least a bounce would come in, and that's what did happen. We got a bounce here. Didn't last very long, only lasted not even a couple of hours. But where you've got an important level, the price subsequently breaks through, that becomes exceedingly bearish. So in the short term, it becomes bullish. Price action has to confirm it's going to move on up. We then find that price action then starts to come off. But the moment that it drops through one of those important levels, as it did, it becomes exceedingly bearish. There's only one thing for a trader to do, and that is just jump on the short side and just stay with it. Now, it came on down to a level which is 70.7. Also, we can just use a little bit of common sense to look at where that level is in relation to price action over here on the left. We can see that it's just a smidgen above an area where there was prior resistance. That's now become support. We get a little bit of a bounce up, and then we get another crash down to this level with a bounce up. We've got one or two very reliable candles in here, such as Harmonic breakout, or we've got an engulfing, etc. And then as price just broke on down through, what are you going to do? Join the party and just short it. Where did it go to? Right, well, we've got a whole series of harmonic lines, of Fibonacci lines, picking up in this level. We've got it from previous lows. We've got it from lows that sort of went back to the middle of last week, bat levels, force break reversal levels, extension levels, and lo and behold, what did price do at that level? Decided to bounce on up. So a very, very useful tool indeed is to be aware of, at the very least, the main Fibonacci harmonic levels. So we've been talking about waves, we're talking about the ABC type moves, and we can see that so often those ABC measured moves is exactly what does actually happen. We've got that move from Friday, an A move down, a B move, and then a C move running down to where it's found a lot of support. So we can just be aware of that. If we can identify an A move and a B move, then the chances are a C move is actually going to follow it. Now, we'll just take a little glance at pound against dollar. We've got very much the same sort of thing going on. 30-minute chart, we've got price then bouncing off these important levels, bouncing off a 61.8, starting that move that kicked off with the that incredibly strong move that just sort of absolutely took off. And there we are, that took off there on Friday, followed through then on Monday, decided that it was just all a little bit too much, and then it just crashed on down for this ABC move, again picking up harmonics right the way down here to the support level, where effectively it became a buy again. Now, what we do, we've got sort of one or two other little indicators that we actually use, and the whole thing puts itself together into a very neat little trading system. We use the 5-minute chart for the intraday trigger. So for intraday traders, the combination of harmonics on the 30-minute chart and then coming right the way on down to what goes on with the 5-minute chart, just interpreting price action, it becomes a very, very useful combination indeed. Now, before we actually leave, let's just take a glance at, let's just remove that one for a moment, bring up. Yeah, let's just bring this one up. There are some very, very useful crosses to be used, but I just want to highlight this particular one. It's the USD CAD. Now, we got a potential move that could well take off here. So we're looking at this daily chart where price of the US dollar has moved up very, very strongly against an ever weakening Canadian. And as you know, Canada is a major oil exporter. And whilst this US dollar was going strong, the Canadian dollar was suffering with the oil price tumble. So we've had an oil price tumble. This whole thing is something of a potential top. It's rather like a head and shoulders top. We've got a key back level, 88.6, where price actually came down and then it bounced up. It bounced up strongly 10 days ago. And right now, it's going to be testing this level. Now, what I just said previously was that where you've got a key level, got a key harmonic level, and if it breaks, then in this case, this was a bullish signal to go higher. But if that level breaks, it will be exceedingly bearish. All of this price action will have a tremendous number of people who are still long. Once price drops down through this level of what is effectively 2400, 124, then all of those longs in there are going to be very, very demoralized. And they're going to turn into shorts. And it's entirely possible that today is going to be the critical day for it. Because price action yesterday put in this little Harmey, this little narrow range candle. And so that adds a little bit of weight that if price decides to break lower from the low of yesterday, we're then going to see a test of 124, a potential break of the back level, and that would give a wonderful shorting opportunity there on the Canadian dollar. Notice that this move kicked off from a Gartley level right the way on down here at the bottom, and that moved up many, many multiples of the extent of that previous pattern. Could the same thing happen now on the downside? That's the question that I shall leave you with this morning. Right, guys, well, it's time for me to call a close. Many thanks indeed for being with me, and look forward to being with you again next month. Got any questions on this? Don't hesitate to wallop them off to me at george@clickevents.com. George@clickevents.co.uk, and be only pleased to answer any of your further questions on this. Bye for now.